All right, everybody. TGIM and welcome to week 45. I hope everyone had a fantastic weekend. Without further ado, we are going to move into a little bit of a special Macro Monday from the perspective of the focus on the crypto kind of assets. As always is the case, I'm joined by the very special James Kim, who will walk us through some bodacious charts. There is no COT report this week. Got it quite a bit late, and we'd already kind of had the deck up and running. Already have quite a few slides. The key takeaway, though, from the COT report is the U.S. dollar kind of positioning continues to get less short. We had another halving. If you recall, last week we were about 10 yards, and a few weeks before that we were about 20 yards, and now we're about 4 to 5 yards kind of short. The least change continues to be on euro dollar, right? With the biggest kind of short position moving on onto kind of the yen stuff. So that's kind of the key takeaway from the COT report, at least on kind of the currency kind of positioning. On financials, we continue to have more shorts being added onto U.S. duration side of things, and also a reduction actually in shorts in equity markets at actually a 10-week low. And on the other side, on duration on U.S. bonds, it's an 8-week kind of high. Read that as you will, in regards to kind of where we are and how we're kind of continue to kind of melt up. Obviously, everything is solely views, opinions. There's no trading, no investment recommendations here. As always, you must take responsibility for your own decisions. So, quick summary of kind of week 44. There was a lot on. Is it a bird? Is it a plane? It's Powell. So we finally got the Fed chair. So much for stemming the leaks from Trump. Kind of interesting here, given the fact that his Wall Street kind of background, lawyer also by training, done some government work. Obviously, very familiar with kind of the Fed. Great to get that kind of overhang. A lot of it was kind of priced in. We did see a little bit of tightening. Tightening in kind of U.S. rates, and the dollar did slide back a bit, but quite a lot of that was priced in, and correctly so. My take from Fed meeting obviously was nothing to see. Initial reading on U.S. jobs, I actually thought these numbers were very good. Yes, the headline did miss 261K was actual versus 313, but the revisions were huge. Plus 50,000 from the minus 33K previously, right? So it got to 18 kind of K. We have unemployment rate at 4.1. And I think it's only a question of time before we get a print below 4. Obviously, the sour spot was the missed and average hourly. 2.7 was expected. We got 2.4. BOE was viewed as dovish, but resulting in a big kind of intra-week reversal on sterling that you can't really see based on just kind of the weekly kind of move, at least here on cable. My view on this continues to be kind of contrarian. I find myself actually wanting to be long sterling, and actually now that I think about it, I forgot to put a trade on that we will put on live here on the strategic kind of book. Equities, same thing, bull market, dude. Equities don't go down, right? And commodities, again, a mixed bag. I continue to be very impressed by how well gold and silver are holding up despite all these kind of reductions that we're seeing in US dollar shorts, and that's something we're going to kind of touch on thematically here, both on the macro kind of overview as well as the charts by JK. And it was interesting to just note, just for the week, how little kind of changed, the dollar was. And actually, now that I think about it, this chart is actually stale. This is from the previous week. Sorry about that. But actually, DXY was very much unchanged, as was the euro. I'll update this chart when we're attaching the PDF deck to kind of the mailing list that kind of goes out. So this is just two charts that I want to do, just play a little bit of devil's advocate, right? This is food for thought. It's not by no means scientific, but obviously everyone's been just wondering about kind of the roundup. And what I'm basically trying to focus on is also something actually JK was talking about this, I think almost a quarter ago, where he's talking about kind of the blow off top in a bull market that can last years and can end up having a majority of the returns. And I think we tend to believe we're in one now. How long it's going to last is once again always anyone's kind of guess. But it was just kind of from context. If you take the bull market that started basically in 91, and this is the NASDAQ 100. I took the NASDAQ 100 because that was the leader in the .com, and the tech stocks are definitely the leader in this equity kind of bull market. And basically from that kind of 10-year period, the NASDAQ 100 went up 2,000%, right? A big portion of that, almost 300%, was basically just the final few years. And then, of course, we all know what happened. We had a huge kind of crash down about 83%. Funnily enough, that's what Bitcoin did in 2014. And then, just another kind of subsequent kind of fall of the GFC, over 50%. And this is now so far where we are. We're up close to 500% on the NASDAQ 100. And of course, as we know, some of the FANG stocks and so on and so forth are up a lot more than that. So this is just kind of now the same kind of period, but here I just want you to focus on the yearly change, basically. And obviously, 2000 was when the dot-com bubble burst, and then that first year we were down 37%, and then we continued to fall into the next. But look at the subsequent years leading into it. It was basically 100% in 99, 85 in 98, 29.7, and 2 years of back-to-back 40 handles, right? And these are the changes that we're having in this current equity kind of bull market. 2015, 2016, neither here nor there, at least compared on a relative basis. Year to date, 30%, right, so far, right, which kind of ties up. And I think, the thing I just want you to think in here is, at least if there's any kind of rhyming to be done with history from a blow-off top perspective and from just a percentage change perspective, there's potentially a lot more that this can go, right? But again, just to be taken with a grain of salt, if not a bucket, just some food for thought in regards to just how these things can last a lot longer than most people kind of perceive to be the case. And anytime I do an interview, it always kind of comes up, what do you think about equities? How much longer can we go? And from my perspective is, until something structurally really changes, I side with momentum, right? It's just kind of the way things are for now. So kind of coming week, we do have, I think, a few key focus points. China's CPI and PPI are going to be the core on econ data. Trump is obviously in Asia. What could go wrong from that? It could be interesting to see what comes out of it. And we have had over the weekend this Saudi cleansing, where there's over 11 princes and billionaires and tycoons that have been arrested on corruption charges by MBS. And it's kind of interesting to kind of see that what the repercussions are of that. For the rest of the week, oil in Asia so far is a bit off of that news. 55.80 on WTI, up about 30 basis points. So not too high, not too low, but still these are key levels, right? I think a month or two ago, if you had said we'd be close to $60 on WTI, most people would have just kind of laughed, right? So definitely bears worth watching, right? On the central bank perspective, we got the RBA kicking off tomorrow, as well as Bank of Thailand, RBNZ, and a host of others basically following up on Thursday, right? Across the street, no one's really expecting any rate decision delta from either of these. Maybe the thing I would watch out for is obviously Mexico. The Banco de Mexico, given how much dollar mex has been pushed, whether we could see a surprise hike or not. There's a few kind of interesting things going there, especially also as you consider that it's a political year next year, and potentially it's a little bit more digestible to do the hiking this year than to do it kind of next year. We have a few Fed speakers, Yellen coming through, Quarles, Dudley, Potter actually on the 9th will be speaking, I believe. Actually, no, I think it's actually the 6th. I think Potter does actually kick it off today. A few other things, just housekeeping. We had daylight savings time shift in the U.S. and Canada. Rhoda also set to speak. Hollows, Norsbank, Olsen, S&B's Jordan, Bundesbank's Widmann, and of course Draghi. From a data perspective, very light compared to the last few weeks that we've had. Jolts out of the U.S. will be key. China CPI and PPI to me is really what it's all about. So watch out for that. And then we do have some final services across the Eurozone as a whole. And also important will be CPI expectations out of New Zealand, milk auction tomorrow. And Australia will be home loans, and then the quarterly RBA monetary policy statement, which will be out on Friday. So I think my thoughts on Fed shares should not be too new from anyone that's kind of been listening in. From our perspective, it's irrelevant. Risks very much to the upside for U.S. monetary policy. The $100 million plus man is in, I have seen quite a few people actually stress that maybe he's nowhere near as dovish as most people think. But from my perspective, it's just really does not matter, right? The tax plan. So we've gotten the first draft. I think we should really have to wait and see. There's some very strongly worded research reports from the like of UBS and MS, just basically saying that the ability of these things to pass The way they're kind of written now is probably quite low. My personal take is we have to kind of wait for the horse trading to finish. On a first draft take only, corporate tax goes down to a flat 20%. There's some addresses of repatriation. There's a simplification of tax brackets on the individual side, which for any U.S. Tax payers is quite positive. And some of the negatives potentially could be the fact that these provisions, if they do go through, would not kick in until 2018, and they would not be retroactive. So, potentially a bit of dilution, but it's also a catch kind of 22, right? To get over the kind of goal line. So early days, I'd say here. Positioning, I think tactically is still unchanged. DXY, it's still really all about getting that to that 97 handle. I think gold still needs to break lower. It'll be interesting to see what JK says on this. We're about 1270 now. We've been talking about this since about 1280. And I think 1240, 50 could work. And, this is ditto for silver. SIL is looking technically very, very dicey. I called this one really, really wrong a few weeks back. I think I kind of picked up the top tick. It actually looks like if we do break that 200 week, which we did close below on Friday, that we could have a substantial fall. There's not much support, to be honest with you. And I continue to think that you want to be tactically short U.S. duration and structurally short duration. I think 2.63 over the next 3 to 6 months is very, very possible. Continue to love having our Jan 2019 Fed Fund futures. I'd be looking to add on to these. We took them off at about 98.28. It's kind of where we are now. I think anything back over 98.35, those kind of levels, I think is interesting to get back on. Also, Bitcoin, been doing a lot of work on this. We've had several seminars, presentations on this kind of last week. A lot of interest. We have a fork upcoming in about 2 weeks. The move to the subsequent fork previously was about 50%. It is worth remembering that Saxo does offer the exchange traded notes on it, also on Ethereum, underlying in Euro and SEC. We'll show that a bit later on. But it's quite interesting with some key news that came out of this kind of last week. Just on the crypto assets, whether you're talking Bitcoin, Ethereum, Ripple, I can't emphasize this enough. This is an essential alternative asset class that one needs to carve out the time and resources for. It's not a fad. It's not some geeky trend. It's not some kumbaya pipe dream. But from my perspective, this is the onset of the biggest technological game changer since the internet. Do the work on the cryptos, understand the significance and relevance of the peer-to-peer decentralized network, the blockchain, the transparency, the security, the accountability, anonymity, and understand why that's different from how currently things are to really, really appreciate the context. Right, the space is still very, very much in its infancy. It's not even a crawling baby yet. From my kind of opinion. Just on the cryptocurrencies, just a few slides. This here is just to give you context. So this note was taken from 30th of October, Monday. It's basically from coinmarketcap.com. It shows you the top 10 crypto assets in the world. Market cap, 103 billion for Bitcoin. At the time, the total volume for cryptocurrencies is about 7.1 billion. Bitcoin's about 3 billion. The total market cap at the time was 180 billion. Bitcoin's 103. Obviously, this was when Bitcoin was about 6,200. We're about $1,000 and some change up higher. As I'm looking at it now, we're kind of about 7,400. To give you context on this volume for the cryptocurrencies, 7 yards, Apple turns over an average of 4 billion a day over the last kind of 12 months, right? So this is not some little pink sheet, highly kind of illiquid, right? And from a context of a fiat currency perspective, which has 5 trillion volume a day, crypto volume is still very, very much small at 0.14% of that, right? You can see from this just some context and valuation that I did last week to emphasize kind of where this could go in a 10-year kind of horizon. We're not going to go through everything in kind of massive detail, right? But it's just to kind of show you ways of potentially thinking about this. The first row really kind of takes it onto kind of gold. I'll cover the first one here, and I'll cover KGAR, and the rest you can kind of look up. I think we had a bit of a slide down with a PDF here. But basically here, if you have maybe the angle that a crypto asset such as Bitcoin will end up being kind of more of a store of value rather than transfer of payments, so it could have a safe haven to diversification aspect. Obviously, the crypto assets basically not correlated with anything. Have very little correlation to bonds, to FXEM, FX G10, VIX, equities. And if you think about it, it makes sense because institutional money is not in there, right? And this is kind of the big kind of I guess you could say plus of looking at that space as a diversification benefit. But here's the whole world value of gold. It's about 8 billion, 7.7. It's about 8 trillion, 7.7 trillion. And Bitcoin value at the time, at least of this, was about 103 billion. Bitcoin value to gold ratio is 2.3. Let's assume that grows to about 20%. You get to a figure of about 77,000 Bitcoin, right? And that's an assumption of 10 years and 20 million coins. I personally don't think this is aggressive by any means. There's a lot of pros and cons around comparing kind of these two. But from my perspective, Bitcoin and a few other crypto assets are already being looked at and used as a store of value. And these things end up having a bit of a reflexivity kind of aspect, i.e. the more people believe in them from that perspective, the more of a manifestation of reality it does choose to become. This here is on to depth ratio, which you can work out and just see yourself. And another one I'll leave you with before getting on to the next page is just if you just look at it from a CAGR and growth perspective. Now, assuming that, let's say, Bitcoin closed at 5,753 for the year, then the median return since 2010 was about 2,018% a year. Now, obviously, extrapolating on that on a 10-year horizon is ridiculous because just the number you get is too big. I think it's bigger than kind of all assets kind of globally. So we basically take that median of 218 and we take an 85% haircut, right? So we adjust it by a factor of 15% lower. 85% lower, and we get to this CAGR of about 32.68. We basically assume that Bitcoin continues to grow at that for the next kind of 10 years, which is here, and you get to this figure of about 1.7 trillion, which works out to about $87,000 per Bitcoin if you have 20 million Bitcoins in 10 years' time, right? And just to give you context, and again, sorry for the dislocation on the slide. I think it's just when we change it into the PDF, it'll be clean for the actual deck we sent through. But to give you context, the CAGR for Amazon from 2001 to 2016 was over 30%. So again, I don't think this is aggressive at all, right? I think it's something actually closer to this 40%, if not north of it. Because also, if you understand how crypto assets work, the ability of people to get crypto assets, it's a lot lower, how should I say, what's the word I'm looking for, entry barriers than, let's say, actually having an account, having a brokerage, and going out and buying an Amazon, so to speak. So the barriers of entry are a lot lower in regards to participating, and from that perspective, it's a great equalizer in kind of transfer payments. These other two are just different ways of kind of thinking about the valuation. Again, take all of this with a bucket of salt. The idea is to give you kind of context, right? On how to kind of view this. Now, we have the exchange traded notes on both Bitcoin and Ethereum. They're through the NASDAQ OMX Stockholm from XBT as the provider there. Obviously, the credit risk lies with them. The underlyings for both are in both Swedish kroner as well as euro. And we basically had some super colossal news last week. For a while, I've been kind of waiting for futures to come through on Bitcoin from the CBOE, which was scheduled for first quarter 2018. But we already got the news last week that the CME is expecting to offer futures this quarter, and actually there's a link here that you can check it out. And from my perspective, this is a multi-generational event. I really cannot emphasize this enough. I think over the next 6 to 18 months, you could see plus 5 to plus 10x on Bitcoin, and some of the other cryptos are going to do even a lot better than this. We've been talking about this space since 2014, but there's no one even more surprised by me with the development of the take-up and the speed in the space. Is just completely mind-blowing. I can't emphasize enough, again, that the risks are huge. The space is really the epitome of volatility. Bitcoin as a whole went down 83% in 2014. I believe this year we've already had 2, if not more, incidents of it pulling back 30% or 20%. Not all cryptos are equal. The regulation is uncertain. Technological changes uncertain. Treatment of taxes uncertain, and there's a lot of obfuscation of information out there, given kind of the vested interests, i.e. are you a Jamie Dimon or are you someone trying to do transfer payments for immigrants in foreign countries, right? So there's going to be 1,000 cryptos that will come and go. There's already been hundreds that we'll never hear of. But all I can do is just say urge you to do this space. And if you're not obviously comfortable with the ETNs that we have available, then obviously as soon as the futures are available, you'll be able to trade that through Saxo. My view on these is kind of how I put here in the strategic book, where basically there's no changes on the tactical book, but in the strategic book, we basically went long core Bitcoin position using the tracker and using the euro underlying, and I've basically just taken it with no stop losses, because I think even if you have a stop loss of 30%, it's something that you can easily get yourself stopped out of. There's no leverage on the ETNs, so I'm just happy to hold it outright, almost like a core, let's say, long-only stock position that you would. And from that perspective, it kind of gives me the optionality of keeping it there and not being stopped out, no running out of time on it. Right? The other kind of update on the strategic book was what we already alluded to last week on SIL. Price action was quite poor, so this also stopped out of the strategic book. Big drag down on performance, but kind of going back to taking more risk into the fourth quarter. That's obviously one of the key kind of risks to that kind of idea, right? And again, the play behind this Bitcoin thing is institutional money that will flow into the space over the next 6 to 12 to 18 months, given the onset of futures, because that I think will bring a cascade of ETFs as well as other kind of products into the space. With that, enough of the crypto assets and Bitcoin. We will do some special webinars on this over the next kind of coming weeks. JK will also help navigate those, and let me pass over to JK to run on charts.
Thank you, Kay. We saw a classical textbook retracement back to the neckline last week over the US dollar index, with fierce buying driving the US dollar off this neckline to produce yet another bullish close for the week. Our buy levels from last week's call started at 94.10 down to the 94 handle. However, the actual neckline retracement came in at 94.12, or 2 cents shy of our level. Now, the fact that the neckline held as support reconfirms the bullish outlook for this week ahead. This week, resistance starts at 95.06. or the October high here, followed by 95.40, or the 50% inverse head and shoulder extension. Any unexpected selling over the US dollar should see the US dollar holding this neckline again, so we should see solid support there. The euro also gave an opportunity to initiate further shorts, as it too saw prices gain back up to the neckline before seeing a decisive rejection on Friday. Interim support to the downside is served at 115.73, or the October lows. However, it's not expected to hold long. We mark two levels of stronger interest that could lead to a bounce: 115.09, or the 38.2% extension, followed by 114.60, or the 50% head and shoulder extension. It is here around these levels, 114.60, that traders could consider taking some profits over any short positions off the table, or even consider a tactical long opportunity. Resistance is obvious: the neckline or last week's high at 116.91. Quick look at where the cable is trading at. After peaking here in September, prices managed to find support just above the 113 handle in October, and an attempted retracement saw prices struggle to push beyond its halfway retracement mark, which didn't signal a positive setup in hindsight. Now, last week's shot at making new October highs here failed yet again at the 50% retracement level, and now is threatening new lows to prices last seen in early September. Now, whilst we expect the market to continue to defend losses above the 130 handle, a break would open its target to the lower channel trend line, or 127.70. So for those looking at any long tactical opportunities, I think can exercise patience and look to enter just below the 128 handle. We've seen prices struggle for the dollar CAD at its long-term 50% retracement between the May high May 2017 high, that is, to this is September low. Now, we had a very shallow pullback here seen so far. That was arrested at the 23.6% September low to October retracement last week. Now, should last week's lows hold at 127.13, prices are likely to resume its recovery to 129 or the recent highs. We do start the week with a slightly positive bias. Any long positions should have the stops below 127.05, targeting 129 to the top side. Now, if we get a break of last week's low, then the prices should focus on finding support at 125.87 or the 38.2% retracement, and these were regional October resistance levels. So these are some good levels to look at some potential long opportunities. The Aussie dollar last week briefly rose above its 200 daily moving average, but this move proved to be a one-day wonder. It reversed all its gains for the week to close just above the 50% retracement level between the December 2016 low to this September high retracement. Now, should this base give away this week, you are now then looking at the December, May, June trend line as next reasons to buy the Aussie dollar. It's quite a challenging environment for bond traders, as after the May, July, October base was broken, the recovery back above this level was achieved with relative ease, and for now the market has seen prices struggle on Friday below the 200 DMA. Despite prices rising back above this regional support line, the bias is for selling to resume. As long as last Friday's high holds, then we would have now seen its second lower higher swing. So the bias is for continued selling over US 10 years. And again, that's as long as the 200 DMA caps gains. Make or break week for dollar yen. As I speak, the dollar yen is now challenging Friday's levels at 114.36. It's about to claim, or it pretty much has claimed, you can say, the 61.8% retracement, which has translated as very strong resistance from May through July until now. Now, prices have made in the past several sessions higher lows throughout last week, and the likelihood of breaking through its 7-month resistance is high, which opens scope for the 115 handle as first profit target, then 115.50 as next level to explore as potential resistance. The euro yen appears to have formed a mini double top at its long-term 2014 down to 2016 61.8% retracement. If we move over to the daily chart, prices have produced its first lower swing high, which also coincided with a failure to push beyond the 50% retracement. So we see opportunities to be short the euro yen with a stop above the double top high, so above 134.50. Target price on all shorts sits at 129 even. Over to some equity indices. Nikkei continues its push after successfully taking out the 2008-2015 upper resistance trendline in an extremely overbought backdrop. The S&P trades in a buy the dip mode, as you can see here by the candlesticks. Any attempted sell down is arrested intra-session and is driven high into the close. Now, whilst prices are making new highs, momentum is diverging. But for now, we have to respect the price action. The target on the ASX 200 has surpassed this consolidation breakout range and now has its eyes fixed on 6,000, which proved to be significant resistance as we saw in 2015. Crude pushes aggressively to new 2017 levels, with the weekly resistance to be served at 56.63. Lastly, on gold, gold has failed its January, March, May trend line and for now hovers just above the 200 DMA. Now, prices do look exhausted. Recent attempted gains in October was a miserable failure here. And we see further losses ahead for gold, potentially pushing prices down for a retest of the long-term 2011 downtrend it broke earlier this year. The 200 weekly moving average trades close to the retest of this trend line, so 1231 is marked on our charts as a strong level of long interest for the weeks ahead. That's it from the charts and the week ahead. Back over to Kay.
All right, fantastic, JK. So just to, again, get a plug in for our team out here. If those who are going to be in Singapore this week, we have our FinTech conference, Wealth 2.0, collaboration is key. This kicks off on Thursday kind of afternoon. It's our flagship FinTech event. We'll be holding it at the Ritz-Carlton from about 2 o'clock. If you are not already registered but are going to definitely be around, then please reach out to your friendly Saxo relationship manager. It's going to be quite an interesting kind of event. Very, very well received last week, and I heard they're going to have a great macro crypto MC who'll be overseeing the event. And again, just to kind of close, we do have a new monthly China macro outlook that I can't recommend enough for people to have a read. This is obviously post party meeting, the 5-year meeting. The key takeaways to get from Andrew are, there's no clear successor for 2022, which basically opens up the stage for Xi to have another term. The fact that he's been put into the Constitution while still being alive is huge, shows that he is one of the most powerful, if not the most powerful leader in modern history in China. There was some potential subtle changes in the language that he used in his speech, indicating that potentially there could be a quality of growth over quantity, so could potentially be okay with having a bit of a lower kind of growth, generally speaking. But this is kind of a fine line to walk in regards to how quickly, or should we say how slowly, the old industries engines of China are going, just given the fact of how many people they employ. And of course, the last kind of key thing is the depth and the leveraging that China knows is a huge concern. They know it is something that they're going to have to address, and it's definitely something to keep watching for them in regards to kind of deleveraging kind of around. A bit of kind of summation on the rest of the deck is, definitely do the work on the crypto assets. I think it's a multi-generational opportunity. What we're going through, they're not a fad. They're not some geeky trend. I think 5 to 10x is very, very doable in the next 6 to 18 months from the likes of Bitcoin with the CME introduction of the futures, which should be coming through this quarter, being a game changer. CBOE is due for next week. And this basically will open the institutional floodgates into the space with ETFs and so on coming through. For those of you who may be thinking, what the hell would they be doing going into this alternative, super alternative asset class? Well, I'll just say, look at all the ETFs people are buying, low vol and etc. in the search for kind of yield. So this to me is, again, something that you're only going to see a handful of times a decade. So I would really urge you to do the space, irregardless of whether you trade with us or not. But of course, my sales trading guys would love for you guys to be able to trade with us. And if you're not comfortable with the ETNs and the proxy trackers we have, of course, you can wait around for the futures to come through and be enabled. And we'd be expecting that to happen over the next few weeks, at least from the CME. Light week ahead from an economic data perspective. Key thing is really China CPI and PPI. Seeing also what Trump says while he's in Asia. If there's anything else coming out of Saudi with this kind of cleansing that they're kind of going through. And of course, to see if there's any real delta from the RB and RBNZ this week, which I don't expect to be. But again, it's all going to be in the wording that will be worth watching out for. And on the charts, technicals, DXY, it's still really all about getting to 97. That's what we're looking for. We feel also that euro dollar is still that kind of 114, 114 and a half is still very much kind of doable. US 10s, the bias is for continued selling. On dollar yen, we think this key 7-month resistance, like a slight touch above 114, is a high chance of that being taken out, opening the upside for 115, 115 and a half. On ASX, of course, that 6,000 handle is key. At least my backdrop of being bullish in commodities suggests that could be taken out, but obviously we'll have to kind of wait and see how that goes. And again, on gold, looking very, very tired. I think we could get back to retesting 1230, which also resonates with our thoughts on kind of a bigger kind of move up on dollar strength. And one last thing I'll add is once I get off this, is I'll put out a long structural core trade on being long sterling and short the Swiss franc around kind of these 130, 90 kind of levels. Wishing everyone a fantastic week up ahead. All the best. Cheers.